Well, with two consecutive half-point rate hikes this year, the Bank of Canada is determined to get inflation under control. Our next guest warns, however, that raising rates aggressively could cause a big drop in home prices and potentially send the economy into a recession. We're joined by Stephen Brown, senior economist with Capital Economics. Stephen, thanks so much for joining us.
Good to be with you.
So it does feel a bit like we're at a turning point for real estate in Canada. We're seeing sales fall off in quite a few cities, prices also coming in a little bit lower. But in your recent note, you said the Bank of Canada doesn't seem to be fazed by this drop in sales in particular. Should it be?
Yes, I think what really surprised me, we obviously had the Bank of Canada meeting just last week, and in its almost 3,000-word economic progress report, which it does after each meeting, it didn't even mention the housing market, which was really quite striking given we are seeing some pretty clear signs of sales coming down quite sharply. And I think the answer is yes, it should be concerned. To be fair to the bank, there is some justification for why it would want to see prices come off a bit. That would help to take some of the heat out of the economy, help to bring down consumer price inflation. But the real danger here is that when it comes to the housing market, confidence plays such a key role. And once we start seeing even just moderate price declines, there's a real risk that that keeps building because more sellers come into the market. And before you know it, you're looking at double-digit price declines, a slowdown in broader housing activity, and that starts to weigh on the rest of the economy as well. And that's why there is this real risk of recession as we look to the start of 2023.
It is interesting, though, striking that balance, by trying to rein in some of the inflation that we've seen in housing in this country, but also balance that with, not making things crash.
Yeah, it's obviously a big challenge that the bank does play. What concerns me, though, is it seems to have really narrowed its focus now onto just longer-term inflation expectations. But as far as I can tell, there isn't much evidence that those inflation expectations are having much of an influence on sort of inflation dynamics. If we look at wage growth, for instance, in Canada, it was only 3.3% in the last month for which we have data. That's less than sort of half the rate of consumer price inflation at the moment. So really all these cost pressures are coming from external factors, the global pickup in oil prices and food inflation. That's hurting households at the moment. So it's not clear to me that the bank needs to be this aggressive and potentially risk bringing the rest of the economy down.
So, Stephen, we were just looking at one of your graphs about mortgage rates on the rise and a bit of your forecast there, because you highlighted that the Bank of Canada Deputy Governor that you mentioned recently was talking about the central bank raising rates, to neutral, but perhaps even beyond that. So you were looking at the potential of a 3.5% for the Bank of Canada's target rate. What effect would that have on mortgage rates in this country?
Yeah, so I think the key thing to note at the moment is that we've seen a big shift in mortgage buyers taking out variable rate mortgages. So that's really the one to look at the moment. So at the moment, they're just a little above 3% on average for a variable rate mortgage. That's with a policy rate of 1.5%. So you can essentially just add on that potential, add another 2% onto that. So we get to a variable rate mortgage of over 5%, which we haven't really seen since before the global financial crisis. But the big picture really is, a policy rate of 3.5%, which the bank has suggested now is quite likely, would be double the rate it peaked at before the pandemic. But in that period, we've seen more than a 50% jump in house prices. So to what extent can the housing market handle almost a doubling of variable rate mortgages? It's probably not going to look particularly good.
Yeah, you had another graph on affordability. I wonder if you could walk us through what that shows.
Yeah, sure. So this one is looking at essentially the house price that a median income earning household can afford. So if there was a policy rate of 3.5%, whether you use a variable rate or a fixed rate, at that point they'll be quite similar. The budget is around $525,000, whereas that's almost $300,000, I think slightly more than $300,000 less than the current average price for a house in Canada. And the reason this has happened to some extent is because housing demand has been so high and supply quite limited for the last couple of years, prices have essentially moved above what the median income household can afford. This is why we have all these stories about parents helping their children buy houses and things like that. But as supply comes back and there are more home sales, there's a real risk that we essentially have to drop back very sharply to clear the market again. And that's why our forecast is that there'll be a sort of a manageable 10% decline in house prices. But once we start talking about 15 or 20% declines, there's a real risk that that creates a cycle where people are forced to sell just because they end up in negative equity, and then that causes prices to fall even further. And that's where these downside risks start looking very pronounced.
I was just going to ask you, Stephen, because the last time we talked, you were talking about this 10% decline possibility. So if the Bank of Canada were to raise its key lending rate to 3.5%, does that still line up with the 10%, or is that more in the 15 to 20 that you just mentioned?
Yeah, that would be more of the latter. So my forecast at the moment has been a policy rate of 2.5%. I was quite comfortable with that until last week when the bank obviously came out and looked extremely hawkish. So I just think, given the impact on the housing market, I still struggle to believe it would go to 3% or even higher. But certainly, if it did, I think we'd be talking about a 20% fall in house prices, and that's where the downside risk of a recession really become quite acute.